Imagine you buy a boring index fund, not a meme coin, not a penny stock, not some guy on TikTok explaining why a company with zero profits is secretly the future of civilization. Just QQQ, a simple ETF that tracks the Nasdaq 100. You think you're buying big American technology companies, Apple, Microsoft, Nvidia, Google, the usual giants, boring enough to hold, exciting enough to brag about at dinner. But now imagine the rules quietly change, and suddenly a company that just IPO'd can enter the Nasdaq 100 in as little as 15 trading days, not 15 months, not a full year of public market proof, 15 trading days. That is barely enough time for retail investors to figure out whether the ticker is real or just another AI-generated finance scam with a rocket emoji in the logo. And this rule change matters because the companies waiting at the door are not normal IPOs. We're talking about possible giants like SpaceX, OpenAI, Anthropic, Databricks, private market monsters with valuations so large they don't walk into an index. They crash through the wall like the Kool-Aid man wearing a Patagonia vest. The mainstream story is simple. Nasdaq is modernizing. Markets are changing. Private companies are staying private longer. If a company is already massive, why force it to wait? And honestly, that argument sounds reasonable until you realize what this really does. Because this isn't just about adding exciting new companies to an index. This is about changing who buys the IPO, when they buy it, and who gets to sell into that demand. And that is where QQQ starts becoming something very different. For years, major index changes were mostly about risk control. In 1998, Microsoft became so large that it reached around 25% of the Nasdaq 100, so the index had to adjust. In 2011, Apple got so dominant that its weight climbed above 20%, so Nasdaq cut it down to roughly 12%. In 2023, after the AI boom pushed the largest tech stocks into absurdly concentrated territory, Nasdaq adjusted again because the biggest names were carrying too much of the index. The pattern was clear. When one stock became too large, the index tried to reduce the risk. That made sense because an index is supposed to represent a market, not turn into one giant stock wearing a fake mustache. But this new change is different. This time, the rule change is not mainly about cutting down the giants already inside. It is about letting new giants enter faster. Under the old system, newly listed companies usually had to survive a public market waiting period. There was observation, there was time, there was at least some public trading history. But under the new system, Nasdaq can look at a newly listed company on its seventh trading day, check whether it is large enough, and if it qualifies, add it to the Nasdaq 100 as early as the 15th trading day. And the key requirement is size. The company needs to rank in the top 40 by market value among Nasdaq 100 companies. Based on recent market conditions, that means roughly a $100 billion type of company. So this is not a fast lane for normal IPOs. This is a velvet rope entrance for mega unicorns. And then comes the stranger part. The old 10% free float requirement is gone. That requirement used to matter because if a company only sells a tiny slice of itself to the public, the stock can become very easy to manipulate. Low float means limited supply. Limited supply means price can move violently. And violent price action means retail investors get to enjoy the full theme park experience, except the roller coaster is their retirement account. Before, if a company had a trillion-dollar valuation but only released 2% of its shares into the market, that could be a problem. Now, the index can focus more on total market value. In other words, if the whole company is valued high enough, even if only a small part is actually trading, it can still get fast-tracked into one of the most important ETFs in the world. And this is the mechanism. Step 1. A private company raises money at a huge valuation. Step 2. It IPOs with a limited amount of stock available to the public. Step 3. Because the valuation is massive, it qualifies for fast entry into the Nasdaq 100. Step 4. Funds tracking the Nasdaq 100 must buy it. Step 5. Passive investors, who never made an active decision to buy that IPO, become automatic buyers. And Step 6. Early insiders, venture capital funds, employees, and private market investors now know that there is a huge pool of forced demand waiting underneath the stock. That does not mean every company is bad. SpaceX may be a real business. Starlink may be valuable. OpenAI may become one of the most important companies of the next decade. Anthropic and Databricks may be serious companies with serious customers. But the question is not whether the companies are real. The question is whether the index is still protecting investors from hype or helping hype become part of everyone's portfolio before the public market has had enough time to test it. Because private market valuations are not the same as public market valuations. In public markets, millions of buyers and sellers argue every second. In private markets, a few funding rounds can set the headline valuation, and those funding rounds can include special terms, liquidation preferences, anti-dilution protections, and other fine print that ordinary investors never see. So when someone says, this company is worth $800 billion, the correct response should not be, wow, where do I buy? The correct response should be, worth $800 billion, according to whom, under what terms, and with whose money. Because in private markets, valuation can become marketing, and marketing is undefeated. According to the article's figures, late-stage private funding grew from about $15.7 billion in 2016 to more than $152 billion in 2025. That is nearly a tenfold increase. That means giant private companies now have access to massive capital before they ever become public. They can stay private longer. They can build a bigger story. They can raise at larger valuations. And when they finally IPO, they do not arrive as small companies begging for capital. They arrive as financial celebrities. And now the index rules may allow them to walk almost directly from the IPO stage into QQQ. That is not a small change. That is like letting a rookie enter the NBA, sign a $300 million shoe deal, get voted into the All-Star game, and then forcing every basketball fan's pension fund to buy the jersey before he plays a full month. Could he be the next superstar? Sure. Could he also pull a hamstring, miss expectations, and make everyone realize the hype got a little ahead of the scoreboard? Also, yes, and that is why this rule change matters, because index funds are marketed as passive. Passive sounds safe. Passive sounds neutral. Passive sounds like sitting on a beach while your money quietly compounds. But passive investing is not magic. It still has rules. And when the rules change, the product changes. If the Nasdaq 100 starts adding mega IPOs faster with less public trading history, based more heavily on headline market value, then QQQ becomes less of a proven technology giant's basket and more of a largest available growth stories basket. That may produce upside, but it also creates new risks. First, volatility risk. New IPOs can move violently because the market has not figured out what they are worth yet. Add low float, extreme expectations, insider lockups, and passive buying pressure, and you get a stock that can look unstoppable right up until reality asks for a meeting. Second, valuation risk. A company can be world-changing and still overpriced. This is one of the hardest things for investors to understand because people confuse a good business with a good stock. A company can build rockets, dominate AI, own satellites, cure boredom, and still be a terrible investment if the price already assumes the next 20 years go perfectly. Third, forced buyer risk. When an index fund has to buy, it has to buy. It does not sit there reading the prospectus with a cup of coffee saying, maybe the valuation is a bit spicy. No, if the stock enters the index, the fund buys. That is the whole point of tracking an index. And that creates a strange situation where passive investors may become the exit liquidity for private investors who got in years earlier. Again, not because the company is fake, but because the timing is convenient, very convenient. The early investors helped fund the company when it was private. They took the early risk, they got the early price, then the company IPOs at a huge valuation, then the index absorbs it, then the public becomes the buyer. It is not a conspiracy, it is an incentive structure. And incentives do not need secret meetings in dark rooms. They just need everyone doing what benefits them. The company wants a high valuation. The insiders want liquidity. The exchange wants relevance. The index wants to include the biggest names. The ETF has to track the index. And the retail investor gets a notification saying, "Congratulations, you now own this." Beautiful, terrifying, efficient, possibly stupid, all at the same time. And while new giants enter, old companies may get pushed out. That is the other side of this change. If a Nasdaq 100 member falls below a certain ranking, around 125th during a quarterly review, it can be removed faster than before. So the system becomes quicker on both ends, fast in, fast out. And the companies most at risk are not necessarily bad companies. They are just smaller, slower, less exciting, and less useful to the news story. A commercial real estate data company does not sound as sexy as orbital internet. A ketchup company does not beat a rocket company in a popularity contest. A cable and broadband company is still a business, but in a market obsessed with AI and space infrastructure, it looks like someone brought a fax machine to a robotics convention. That is how index composition changes, not emotionally, mechanically. The rulebook changes, the flows follow. The ETF adjusts, and ordinary investors wake up holding a different risk profile than the one they thought they bought. This is where the historical parallel gets uncomfortable. A few years ago, Hong Kong's Hang Seng Index expanded and brought in more high growth, high valuation new economy companies. Some were exciting, some had huge stories, some were exactly what the market wanted at the time. But when expensive growth stocks enter a major index, they do not just bring excitement, they bring valuation pressure. They bring volatility. They bring the possibility that passive retirement money ends up buying companies at the exact moment insiders and early investors are looking for liquidity. And the US version could be even bigger because QQQ is not some tiny niche ETF. It is one of the most watched, most traded, most widely owned tech focused products in the world. So when its rules change, it does not just affect traders, it affects retirement accounts, monthly investment plans, tech funds, pension exposure, and anyone who thinks they are simply buying the Nasdaq. Now, to be clear, this does not mean QQQ is doomed. It does not mean SpaceX will crash after IPO. It does not mean OpenAI is fake. It does not mean every mega unicorn is a bubble. The world is more complicated than new thing bad. Some of these companies may become the next generation of dominant businesses. But here is the uncomfortable truth. The more an index rewards size over seasoning, the more it can turn private market hype into public market exposure before ordinary investors fully understand what they are buying. That is the risk. Not that innovation is bad. The risk is that innovation gets packaged, priced, hyped, indexed, and quietly delivered into your portfolio before the public market has time to separate the real business from the beautiful story. And stories are powerful. Stories make investors ignore losses. Stories make valuations feel normal. Stories make people say things like, "This time is different," which is historically one of the most expensive sentences in finance. The companies entering the Nasdaq 100 may be incredible, but incredible does not mean cheap, and passive does not mean risk-free. So what should investors actually watch? Watch the float. If only a tiny percentage of shares are available, the stock may move more dramatically than its market cap suggests. Watch the lockup. When insiders are finally allowed to sell, the supply picture can change fast. Watch the valuation. A $1 trillion story still needs $1 trillion execution. Watch the index weight. A company entering QQQ is not just another stock, it becomes part of the machine. And watch the language. When everyone stops asking, "What is this company worth?" and starts asking, "How soon can it enter the index?" that is not investing anymore. That is financial event planning. So maybe this NASDAQ rule change is modernization. Maybe it is simply an adjustment to a market where private companies are larger than ever before. Maybe it helps investors access the next generation of winners earlier. That is the bull case. But maybe it also creates a cleaner exit ramp from private markets into public retirement money. Maybe it makes QQQ more exciting, more concentrated, more volatile, and more exposed to companies that have not been tested long enough as public stocks. That is the bear case. And the most honest answer is probably somewhere in the middle. This rule change may create opportunity, but it also changes the product. And when the product changes quietly, investors should pay attention loudly. So here is the question. Do you think this is good for QQQ because it brings in the next generation of winners faster? Do you think it is dangerous because it turns passive funds into automatic buyers for expensive IPOs? Or do you think this is just how markets evolve and everyone complaining will still buy the dip anyway? Drop your answer in the comments because QQQ may still look the same on your brokerage app, but under the hood, it might be becoming something else. Thank you so much for watching. Please comment, like, and subscribe if you like our video. Hope to see you again.